presentation contains current opinions of Moe Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Moe's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Moe.
Hello everyone, and welcome to the Compak Asset Management YouTube update. I'm Moe Ansari, President of Compak Asset Management and host of Market Wrap. Again, don't forget to download the app to get the daily edition of Market Wrap downloaded directly to your iPhone or your iPad or your mobile app. You can go to the iTunes store by simply clicking on the link below and downloading the app. It is absolutely free, and then you'll get the 1-hour daily broadcast every day downloaded to your iPhone or your Android phone. Looking at the reopening, we are at 90%. That's where we are from where we were at 100%. This is pre-pandemic. We went all the way down. Now we've come all the way back up. It has been a long road, but we are at 90. So we are coming back, but there is some question with Delta, how much that is going to slow down, if any, the economy, consequently the stock market. Looking at the reopening, we are at online travel was the big winner here. Everybody is looking at online travel. They're starting to book vacations, starting to try and get those vacations done. As I mentioned a couple of months ago, I thought August and September we'll get this surge, everybody traveling, using up their credits that they accumulated over the last year, the vacations that they had not taken, and try to get those done before schools open in September next month. So I think once we get back into September, we'll get back to a sort of a normal rhythm. Where will it be? It's like a plane taking off. Initially the economy took off. Now we've hit a little bit of turbulence and we're trying to find some clean air where we're going to plateau, and that's where everybody's trying to figure out where the economy is going to go from here. We are still seeing a little bit, we're still 21% lower on TSA checkpoints. We are a little bit lower on transit mobility, but we are coming back. How much does Delta slow us down? That's the big question. Looking at the big news this week was the unemployment data, and I'll talk about that in a second. But looking at, we are just about back to where we were. In most of the things, we're down about a little bit in steel production, down a little bit in hotel occupancy, about 7-8%. We're down a little bit in hotels and restaurants. Travel is still down about 21%. This is the people going through TSA checkpoints. We are higher in gasoline usage, and we're still lower in global travel. That is still, I think, will come back as the rest of the world gets vaccinated. Unemployment fell to 5.4%. We did get the numbers today. The unemployment data, we added 943,000 jobs. The estimate was that we were going to add 880,000 jobs, so the number was higher than expected. That could push the stock market up to new all-time highs early this morning. This week we hit new highs. We did back off a little today in the Nasdaq, but we still closed at new all-time highs for the Dow, for the S&P and the Dow. So the market continues to move higher. Companies are hiring, and that's what it shows, but there is still some strain in getting enough employees, even though the unemployment level is 5.4, still not to where we were pre-pandemic, but we have come way up from where we were at the depths of the recession and the pandemic last year. So I think we're going to continue to make progress, especially as the added unemployment benefits go away in September. A lot of people are going to come back to work, and that'll bring these numbers further down. The question now is, when does the Fed start to taper? When do they announce their tapering projections? Interest rates, so we saw them come all the way down, hit a low of about 1.12 last week, and then we retested that earlier on Wednesday. Now we're right back at the 200-day, which is the yield is about 1.927. We closed at about 1.29 today. So we are very, very close to a 200-day. Looks like we've come all the way down in the yield from 1.7 where we were in March, and here we are down to about 1.1. We could come back up if we get above the 200-day on the yield. The next target would become 1.4, and that's our 1.5, which is about the 50-day moving average. Overall, I think we are starting to see the economy come back up. We are going to see an announcement from the Fed, maybe this month or maybe next month, on when they're going to start to taper. That means cut back their bond buying program. Right now, they're buying $80 billion of treasuries, $40 billion of mortgage-backed securities. The expectation is that they're going to say that they're going to start tapering this bond buying program or putting cash into the system and reduce it by about $15 billion per month. So it's $120 billion. It still could take about somewhere around 10 months or so before we get, or 8 or 9 months or so before we get back to zero. And that will again depend on how the economy does. That's the expectation. Once they have gone back to zero as far as the quantitative easing of bond buying program is concerned, that'll be somewhere in the end of 2022. And then they'll think about raising interest rates depending where the economy is, how we're doing as the economy depends, and where inflation is. Those are the two drivers. The unemployment rates also. Looking at the S&P, new all-time highs this week. This is a 60-minute chart where each bar is only 60 minutes of trading. We hit a high and then we've come back. Now the target, my target was about 44.35 was my target. We are right at that target today on a close at 44.36. So the next target now becomes somewhere around 44.60. And if you look at our daily chart, that is also at 44.60, an extension of the fifth wave. The support is going to be right here at the 20-day moving average, which is 43.82, then the 50-day moving average, which is 43.07, and then all the way down to the 200-day moving average. But I think support is right here. We also have support at last month's lows, and then the June lows are also going to provide some support to the S&P. If we do start a correction, everybody has been looking for a correction, including me, or a pullback. There has been none, and that's one of the hardest things to do, is try to predict pullbacks, and that's why I've always emphasized to having a balanced portfolio, staying with the market. You have to give the market the benefit of the doubt. As we see, nearly 75 to 80% of the time over the last 40 years, the market closes higher than where it starts the year. 75 to 80%. So you want to give the market the benefit of the doubt and stay with it as long as possible, somehow to avoid the major recessions or the structural problems. The market will go up and down. Every year we see about a 14% pullback on average in the market, but that's the market volatility. That's the price for being in the market. Trying to avoid those is what I believe is a fool's game, trying to try the little wiggles in the market. Third wave extension also comes at 44.75. This is a weekly chart. Wave 1, wave 2, we're in wave 3. Somewhere we are going to get a wave 4 pullback, maybe later on. Sometime, I was expecting August and September, but the market does not seem to want to pull back. But we still have time. Plus we have Delta that is getting out there. The infections are going up. Thank God the hospitalizations and the mortality rates are not going up, which is the good thing, but the infections are going up, unfortunately, for the unvaccinated. We are even seeing vaccinated people and getting the infection, but if they are vaccinated, the chances of ending up in the hospital or mortality is low unless you have underlying conditions. So we are seeing the surge. We're about 2 to 3 weeks behind the United Kingdom, the UK. There we saw a surge of Delta much larger than what we're seeing here on a percentage basis, but that is starting to come back down. And I think that is going to be the same case here in the United States. We're going to peak in the next couple of weeks and then start coming back down again. But the market, the trend is your friend, and the old saying is, and the market is trending, continues to trend higher. Nasdaq new all-time highs yesterday, backed off a little bit today. Support is going to be the 20-day and then the 50-day moving average, then the long-term support at the 200-day. The target now on the upside becomes 16,000 for the Nasdaq on the upside. Looking at the weekly chart, 16.4 is an extension of the weekly chart for the third wave extension. Somewhere we've got 14,000, 13,000, and then all the way down to here, 9,000. This is a 200-week moving average, 50-week moving average, and the 20-week moving average. These are going to be support areas for the Nasdaq on pullbacks. Gold had a very disappointing day. Earlier on in the week when we saw yields coming down, that should have pushed the gold market higher. It did try to come up last month and come back or test the 200-day moving average. Even one day we closed above it last week, but that today we started to come down as interest rates went up dramatically when we got the stronger than expected unemployment data. that pushed interest rates up, and that gave strength to the dollar, and that is negative for the crude oil, for commodities, and specifically for gold. Gold had the worst day, and I think it closed at the lowest level we've seen since June. So it is starting to show some weakness. Support now is right here. This is the June low. If we break that, we could be headed back towards the March low, which is around 1660 or so, the double bottom that we made here. But gold should have gone up. It had all the ingredients to move higher. We had higher inflation numbers, lower interest rates, lower dollar, but we just barely could not get any move. And now, first day, we get some negative news and the market went down. That is not a good sign. Emerging markets, the same thing. COVID, or the Delta variant, continues to wreak havoc in the emerging markets. We got below the 200-day, came and tested it on Wednesday right here, could not get through it, and now we're starting to drop back a little bit. But if we can get above this 54 area, which is the 50-day moving average, I believe long term this is where we should be headed in emerging markets. This recovery is going to ricochet around the world. That is my feeling, but it is taking a little bit longer because of the Delta variant and not getting the vaccines out to the emerging markets yet in quantity. The small cap Russell still stuck in the 2360 to 2100 area. We did come back and test the 200-day, bounced off of it. Now we're pushing the 50-day moving average at 2265. We closed today at 2247. If we can, this is the reopening trade. It has been going nowhere, as you can see, stuck in this range, back and forth. If we can break out above here, these are the highs, 2360, then we could accelerate and continue. But that will depend on when everybody feels comfortable going out without masks and without the scare of the Delta variant or COVID. And right now, unfortunately, that is coming back. Don't forget to subscribe. Like and subscribe to it. Just click on these buttons, and you'll get notified every time I do an update. You will get automatic notification. I'm Moe Ansari. Thank you for joining me, and I will give you an update next week. Until then, good trading.
This presentation contains the current views and opinions of Moe Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.